Welcome, everybody. As you're trickling in, we're just going to wait for everybody to join before we really get into a discussion. So let's let everybody get in the Zoom room. We do see you, and we're going to be starting in just a moment. Give it just another second or two. All right. Well, welcome, everyone. Thank you for joining us for this webinar today, The State of Cannabis Capital Markets, Restructuring and Insolvency. My name is Ruth Rawls. I am a Vice Chair of Saul Ewing's Litigation Department and a member of the Cannabis Law Practice Group. And I am joined here today by two of my partners, Steve Raven and Peter Murphy, along with our guest panelists, Jacques Santucci and Peter Sue. Steve Raven is a highly seasoned insolvency and bankruptcy attorney with more than 40 years of experience. Peter Murphy advises cannabis industry clients on regulatory compliance, licensing applications, and corporate transactions to support the launch and growth of their businesses. Jacques Santucci is president of Opus Consulting, a business performance management firm specializing in the cannabis industry. And Peter Sue is a banking executive with 20 plus years of experience. He has personally spearheaded 2 cannabis banking programs as team leader at large FDIC insured banks. I'm going to let each of our panelists today give a little bit more of their background and introduction as they answer the questions, but I wanted to make sure that I had a chance to just introduce them and let you all know who's joining, who's going to be speaking today. So before we begin, a few housekeeping items. There is a Q&A in this webinar, and questions can be submitted through that Q&A tool at the bottom of your screen. We'll answer questions at the end of the entire program. However, Peter Murphy and I will be monitoring that Q&A as we go through, and if we see something that's kind of similar to what we're talking about, we might just toss that in. So please feel free to throw them in whenever they come to mind, and we'll keep an eye out for them and look at them. We'll do our best to answer all those questions that are submitted. If we run out of time or we don't get to them, then we'll follow up with you individually by email to circle back on that question. The webinar recording and handouts, following the webinar, you're going to receive a follow-up email that'll include links to the webinar recording and some supplemental presentation materials, so you will have that. And then, of course, the all-important legal disclaimer for any webinar provided by a law firm, that the provision and receipt of the information in this program is not legal advice, does not create a lawyer-client relationship, and should not be acted on without seeking professional counsel who have been informed of the specific facts. So now that I have done my housekeeping and my appropriate disclaimers, we're gonna get started. So I'm gonna moderate today with some questions to our panelists, but before I do that, I don't want to assume that the folks that are joining us today may have a wide-ranging level of experience in the cannabis industry. So I just want to do a little bit of level setting at the beginning and address kind of the elephant in the room, which is where we usually start with any cannabis-related topic. So as with many things cannabis-related, industry participants and lawyers frequently find themselves dealing with unanswered questions and procedural hurdles due to the continued federal illegality of cannabis. So I'm sure most of the folks here, we all know marijuana is a Schedule I narcotic under the Controlled Substances Act, which means, according to the federal government, it has high potential for abuse, no currently accepted medical use and treatment in the US, and a lack of accepted safety for use under medical supervision. Notwithstanding the federal prohibition, many states have enacted medical programs. We are seeing a lot of states move to adult use programs. So when we are talking about cannabis regulations, anything in the industry, it is really a function of state law, and that is the statutory scheme that we are talking about. So what that means is that the industry doesn't necessarily have the protections of federal law available to it. And one of the things that we're going to be talking about today is bankruptcy, which is a function of federal law, and how and when in cannabis industry participants can use that or use other methods to deal with insolvency. So we're going to talk about that a little bit. Now that I have the table set, I'm going to jump into some questions. And I just want to let you all know that we do have a couple of slides that we're going to refer to throughout. By no means is this a slideshow presentation where you're going to be reading slides, but to help illustrate a few of the points we're going to discuss, we have a few of those we may want to pop up. So let's talk a little bit about capital markets. 2022 was a difficult year for cannabis licensees, despite the overall industry expansion and the continued adoption of adult use in many states. 2023 continues to show some challenges. And I want to go to two of our panelists, Jacques and Peter, that in light of your background, kind of what you've been doing in your experience, can you just share your thoughts on where you see the capital markets? And I'm going to go to you first, Jacques, to kind of talk about that.
Yeah, so thank you first for organizing the webinar, and welcome everybody. I'm really happy to be here and discuss our experience and how and this topic. So I've been involved in the cannabis industry since 2010. We participated as consultants and then as co-founder, one of the, if not the first one on the East Coast, first operator. So I was first an operator and then continued to be a consultant. And I would say that the industry is still continue to grow, and it's never been easy. So I am not too surprised that, you know, when you say we talk about challenges and the 2022 and 2023 are challenging, you know, it's been a challenge since day one. It's pushing the rock up the hill, and sometimes the rock goes down a little bit. But what I've been seeing, and maybe we can look at the slides, you know, what I've been seeing is that the industry is still growing, right? We still have 39 states that have cannabis now. The market is growing, and what I've seen is that the capital on the market might be a little bit challenging, but it's still there, right? Companies, new states are coming on board, investors are still investing, and I think what they see is a growing industry that is adjusting. You know, we're expecting, you know, 38 million by 2024, and it was what, 20 billion 5 years ago. So it's still growing. More states are coming on board. We're seeing bigger companies coming on the market, at least on the U.S. legal cannabis market, and I know it's internationally the same way. You know, beverage companies are investing. New products are coming on the market. So when we talk about bankruptcy and receivership and challenging, I think we still have to keep in mind that there's still a lot of opportunities. There's new products, new consumers, and the market is still growing.
Great, thank you for that. And Peter, Sue, I'm going to call Peter, Sue, and Peter Murphy by their full names today. They are not in trouble for those of you joining us. I just want to make sure they know which one I'm talking to. So Peter, based on your banking experience and kind of your background, could you give us a little commentary on kind of what you see with respect to the capital markets for the cannabis industry?
Sure. Thank you. So as you mentioned, I personally spearheaded 2 separate programs as an employee at banks. I've also acted as consultants to maybe around 100 banks or credit unions all over the country. So my view is more banking and financing. So this is traditional institutional capital. I'm going to agree with Jacques. When you think about the industry is kind of, I don't know, split personality, right? Like in certain markets, and of course, as you were pointing out in the beginning, because it's a state-by-state regime, it's a state-by-state market. So in certain markets, the older markets, let's say California, Colorado, yeah, you are starting to see some perhaps contraction. We're seeing lately certain MSOs have pulled out of certain markets, for example. But at the same time, we have new markets coming online kind of all the time. You know, you have New York, New Jersey, Connecticut. So what capital is flowing into those states? Well, obviously those are new capital. Right. So to say that there is not new capital available, that's probably not totally true. Of course, on the public market, we are seeing, hey, look, the stocks are down. So M&A activity is down. Obviously, there's probably less of those type of capital. From a debt perspective, actually, it's never been higher.
Yeah.
In fact, banks are increasingly lending more and more into the space. So even when we think about bank debt or institutional debt, that is more and more available, again, more than ever before. So I guess that's the interesting dichotomy where it's both contracting and expanding at the same time.
And if I can add something, Ruth, I agree with Peter. think we're comparing something. Let's say we're comparing with 5 years ago, where a lot of capital were coming on the market from an untraditional way, and some money was invested with maybe not the proper way, the proper due diligence, or maybe not realistic expectation. I think what we're seeing is more of an adjustment to a more favorable capital market to the appropriate players.
That's a great point. And I just want to make sure that we get to this next slide as well, because I think it does talk a little bit about the size of the industry. So if we can move to the next slide, Maddie. And then I want to follow up with both of you. When we're talking about distress in the market, and I realize we've kind of got this dichotomy set up based on what states are doing, what do you think some of that distress is attributable to Jacques or to Peter, whoever wants to jump in on that one?
Yeah, I'll start, Peter, and just that slide puts everything in perspective to me, right? If right now we are 27 billion, let's call it 24. It's bigger than Starbucks, and Starbucks is at every corner, right? And around us. So it gives you a perspective of how many stores and how big the market is. And it's what, half of the cigarette market. So we are talking about a growing industry that is here to stay. And one of the reasons we may be talking about distress is that it was a very rapid growth, right? Like Massachusetts started barely 6 years ago. New York is not even on yet, right? Oklahoma, Michigan, right? They were just a few years back, and they've been growing very fast. So I think we've seen a green rush, and maybe we have lost sight of the basics of business. And I think that created some challenges, around those companies that didn't see things coming their way, and then now they are in a kind of in a bind.
Yeah, I promise Jacques and I didn't coordinate this in advance, but besides our practice sessions, but I agree. But I agree. I think in the early days, so when we think about the stress, I think in the early days, there was a lot of, let's call it irrational exuberance, right? Valuations all over the board. To be fair, how do you put a valuation on a license? What's the right multiples for a cannabis business? The right multiples for a retail versus a grow, et cetera, et cetera, et cetera. And again, a state by state, market by market sort of regime.
Yeah.
So again, the dichotomy of an industry that is both contracting and expanding. And when you look at this graph here, I mean, it's stark. It's unbelievable to believe, looking at these numbers here, that this industry would have companies that are in trouble. That said, and maybe we're going to cover, I know we're going to cover this shortly, but it needs to be said that the margins are tight. I mean, with 280E, with supply chain issues, the inability to scale across state lines, that of course, those are the challenges. And I think in a way, it's good and bad, I guess. The players that can make it under the most hostile conditions that currently exist, those are very strong players.
And interestingly, I think we'll see the cannabis industry being a topic of MBA courses, right? Where it's almost textbook to what all of us learned in school, where, too many players right now, they're all going to merge in the next few years. Some of them not going to make it. It seems unfortunately a little bit logical.
Interesting. Peter Murphy, is there anything you wanted to chime in there before we move on to our next topic? I don't want to cut you off before I give you a chance to jump in.
No, I think Peter, Sue, and Jacques covered it really well. I'll hold off for the next topic.
Excellent. So
I'd like to chime in.
Oh, sure. Go ahead, Steve.
I have a comment and then a question of Peter, Sue. The comment is that I find it mind-blowing for me to even have this webinar. As you've heard, I've been practicing for over 40 years, which means that I'm a product of the 50s and 60s. And to think that 30, 40 years hence, we would have a webinar with marijuana legalized in 22 states, or however many it was, and billions and billions and billions of sales. that are even recourse, just ironic to say the least. My question of Peter Sue is, you mentioned that more and more lenders are getting into this space. And at the beginning of the planning of this webinar, I was tasked with finding a lender to be on the panel. And it was not an easy task. I mean, I asked many people, lenders, brokers, and it seems that not too many lenders are in the space. So categorically, if you can say, what type of lenders are in the space?
That's a great question. Stephen, it's important to point out that, I mean, keep in mind, we're talking about a relatively short time frame, right? All things considered, we're talking about roughly 10 years. So yes, in the early days, the industry was literally unbanked. And we're just talking about a checking account, forget about lending, right? So it's really only been the last, let's say 5-6 years where banking has picked up and lending has picked up. Predominantly, the lending that are available from a traditional financial institution perspective is commercial real estate based. So, you know, buildings, farms. So these are the grows, the retails, et cetera. However, and I'm going to use this as an example because this is public information, so you can look it up. There was a recent deal. It was Trulieve. They were able to raise $71 million of bank debt, 7.5%. It was 3 FDIC insured banks that participated in a syndicated loan. And so that is just pure lending against enterprise value of a cannabis company. And again, a plant touching entity.
So now that we've got capital, let's talk a little bit about what happens when we don't have capital. And we have to deal with some of the aspects of bankruptcy and things like that. And Steve, I was hoping you could just give us a little bit of a primer or some perspective on why bankruptcy is not necessarily an option for a cannabis industry participant, and what that kind of looks like for the folks that are joining us today.
Well, for the same reason that there are not a lot of lenders, especially money center banks in this space, bankruptcy is not an accepted option for a troubled cannabis-oriented company. The federal laws are such that it's illegal to be in that kind of business federally. So when you talk about crossing state lines or moving money around to different states, as most businesses do, it's just not, the federal government has not accepted it. And perhaps it's moving in that direction, I'm sure it is, but it's not there yet. So troubled businesses are left with either state court insolvency options like assignments for the benefit of creditors, which is very similar to a bankruptcy, or receiverships, which Jacques will talk about a little more, or out-of-court agreements, which don't involve state courts, doesn't involve bankruptcy courts, and it's just really negotiating with the creditors, whether it's lenders, taxing authorities, or vendors, to resolve the debts. And that's actually probably the most popular type of alternative to bankruptcy, as well as the least expensive.
So let's talk a little bit about how we stay out of trouble in the first place before we talk about how do we get out of that trouble. So when we're talking about kind of some of the issues that arise for participants in the industry, you know, what are some key practices that can keep a cannabis business from running into trouble? Or alternatively, even in your experience, what have you found lacking in the cannabis businesses that end up in need of restructuring or becoming insolvent? I'm going to turn to Jacques, to you first. If you can just provide a little comment on that, it'd be really great.
Yeah, absolutely. So just to remind everybody here, I've got a consulting firm and been a consultant for almost 20 years now, but in between also an operator in a few states as in the cannabis industry. And the projects we've been involved in, I think, were successful or kind of successful because we follow the basics of business. And we have a slide on the potential reason why people are getting in trouble. And I think it's by looking at those reasons, I think it tells you what you can do to avoid, getting in trouble. What we've seen is a lot of bad business planning. The no financial model or insufficient realistic model, unanticipated market moves, too much competition, or not even being realistic about the market, thinking that the break-even point is going to, it's going to be quicker than expected, and then things, happen faster than expected. What we've seen also is, and that's what's needed, is a good team. You cannot be successful in business if you don't have the right people on the right seat. And we've seen people getting in the cannabis industry with knowledge on how to grow cannabis, but that doesn't mean that you know how to sell it. That doesn't mean that you know how to get customers to come and get your brand. Some regulatory issues that leads to unfair competition disadvantage. That's been all around the country. There's some places, some towns put some hurdles that are very difficult, and that creates a struggle. So being realistic about this probably going to help, mitigate some of the risk. There's some examples of mismanagement, but overall, I think there's also an issue with capital and how the financial structure was not put in place properly, and then creating some real challenges. Like, we've seen leases for spaces that are out of this world, percentage of sales and double price of on compared to the market. It sounds like a good idea when you getting in and you think you have huge margin, and then a year later the deal doesn't make any sense at all, but you're in for 5 years. Then, unfortunately, the 280E, right? We know it's an issue, and we've seen companies not realizing that they are doing this for a return to the investors, and the bookkeeping is not done properly, and the 280E impact is not taken into consideration properly, and sometimes not even at all, or they think that they know how to do it, and they're leaving things on the table. And so all those things, I think, answer your questions. Use the best practices. I think be realistic, be pragmatic. It is a business. It is not a lifestyle business, at least for most people that got investors, and got to focus on how to be a long, sustainable business that generate profits and cash flow.
Yeah, and I just want to kind of highlight one of the things you said, which is the regulatory hurdles. And I don't think that can be underestimated in any market, because this is a industry that is entirely reliant on state regulatory structures, some of which are brand new. And to say that I think some of them are working at the kinks is an understatement, as we watch kind of litigations pile up and unanticipated cost and local control and municipalities, wanting to do things that maybe the state doesn't agree with. So regulatory hurdles in this space are definitely something that is real, and is a very real pain point for a lot of companies.
Yeah, and Ruth, I'd love to add to that, just in the sense of building in a certain amount of flexibility, adaptability is so key, because those regulatory changes can sort of come out of the blue at times, and if a business model is set up very rigidly for one sort of, market, and, we're seeing this, I think, in New York right now, right? We have licensees who are very well positioned there for the rollout of adult use cannabis, but then suddenly that rollout looks so different than what people had anticipated, and now they have to adapt. So it is this balance of maintaining flexibility, while also, having a thought out business plan and strategy.
And I think at this point too, we got to realize that the cannabis industry is not what it was 5 years ago or even 10 years ago. You cannot think that because you think you're growing the best product, it's going to be enough. You got to be different, right? It's not you open, they will come. You got to have something different, either a different type of product, a different type of customer approach, a different type of team building, a different type of handling your financials. It's competitive, and the market is tough.
Peter, so do you have anything you want to add to that laundry list of problems that we
Yes.
just laid out?
Well, not to get shot and fried here, but with now certain examples of company having gone under, and our ability to sort of look back and play Monday morning quarterback, I think we see a lot of reasons that's easy to dissect and say, okay, we know exactly what happened here. So let's look at some recent examples. There was a company in Michigan that recently filed for that recently went into receivership. And now, because this lawsuit's flying, all the paperwork are out, and we see that they have a note, 25% APR. That is a very high rate. Let's assume that the owners of that business penciled out the math. Well, that math probably penciled out at the high of the market, right? So in other words, when Michigan was selling for $2,000 a pound, maybe that business was able to service the debt of the 25% loan. When the market halved, literally overnight, the math simply just did not work. That loan essentially took them out of business, right? So there's a couple things to think about there. One, why did you assume that the $2,000 a pound would continue? We've seen this over and over again, where markets come online, there's an undercapacity, then suddenly, boom, there's an overcapacity, right? So the fact that they didn't anticipate that is probably myopic. That it has literally happened in every market. So again, when we play Monday morning quarterback, I think we can see that, right? That there is a very simple thing that happens where when a state is new, and we're seeing this here in New York, Peter Murphy phrased it very politically, right? We're having a rollout issue. So if you have a situation where there's 300 cultivators and everyone's thinking the same thing, hey, if I could double my capacity, I can sell that out. But keep in mind that what if everybody thought that? What if everybody thought, if I double my capacity, I can sell all that out? And in the meantime, the state is issuing more cultivating licenses. So again, playing Monday morning quarterback, we can see very precisely what happens to some of these businesses.
I would like to add something here. I agree with Peter. Some of those deals too.
We did coordinate this in advance. I'm sorry.
Yes, right. That's right. That's my cue. No, but more seriously, I think some of those deals were put in place too, and the follow through was not proper. So because a few years ago, 6, 7, 8 years ago, a lot of those companies had to be nonprofits, so no ownership, banking issues and financing issues. Some of those deals came as loans, almost in disguise of equity investment, and the 25%. And I don't know exactly what the one you're talking about, Peter, but some of the deals that I've seen came as a loan in disguise of real equity. And so a 25%, interest is a way for the investors, and management contracts was a way for the lender/investor to get their return. Well, at the end, once it's in paper, some people move on, the companies are changing. 2 years later, somebody doesn't remember that the deal was like this because there was no other structure to change it, and they stick to the numbers. And I think it's a little bit in advance of what we're about to talk, but at that point you have to realize that it wasn't meant as a 25% interest forever 2 years ago, potentially, because that was just a way to get through. And maybe having a way to renegotiate, we could probably change some of the dynamics that we start seeing on the market now.
Well, with
Sounds
that
like they could have used a good lawyer from Sal Ewing.
Yeah, with that segue, I'm going to jump right into restructuring, insolvency, receivership, regulators, and all that good stuff. So, it's understandable based on kind of all this discussion we've been having that cannabis companies and non-cannabis startups that may be ancillary businesses might find themselves in a situation where they need to sell assets, restructure debt to remain solvent. And so I want to just start with you, Peter Sue. Can you provide some kind of input, practical guidance about how debt can be restructured to avoid insolvency in this space, or some kind of, based on your experience and what you've seen?
So good news, bad news. Good news is if you have bank debt, so traditional lenders are if you think about traditional underwriting practices, if you're a cannabis business that's able to check all those boxes, congratulations, you've done all the right things. Your business cash flows, you've got solid assets, there's a collateral that the bank can hold, et cetera, et cetera. Banks, of course, traditionally are more conservative lenders than downstream alternative lenders. So where I'm driving at is if you're one of these companies that has bank debt today and you're starting to get to a situation where you need a little bit more juice, you most likely have options. So let me give you an example. I get this phone call all the time. Hey, I've got an indoor grow house. It's worth $30 million, right? I look at it and I say, well, it's really just a giant warehouse, isn't it? So it might be worth $30 million if I can find a comparable licensed income producing entity that wants to take it over. But as a bank, I look at go dark value, and that's maybe $10 million, right? So I'm willing to give you 50%, so $5 million. In that scenario, it'd be probably relatively easy for you to go back out and find an alternative lender that would give you the cannabis valuation. Thus, you've just cleared up $10 million in liquidity. The bad news, I guess, would be if you were the person that took that $25 million loan, the usury rates, the high LTV, you may be limited in options. So again, prevention here really is the key medicine.
So let's talk a little bit, kind of, Jacques, if you could talk a little bit about kind of like funding deals that aren't realistic, how they're contributing to some of these issues and what you've seen in the restructuring and insolvency side.
Well, yeah, I mean, I don't know where to start, right? It's because those deals or those situations have different forms, and I think the non-realistic expectation is the fundamental issue there, and I think most of the issues that we're starting to see on the market could be resolved if there's a communication between the parties. And Ruth, I think you mentioned litigation in what you do every day, so I'm sure we all know that it's unfortunately not the case. But the non-realistic deals that are out there are going to continue to generate more distressed assets. Bad leases, high interest, and no communication. Players changed, right? It's not the same people that were there a couple of years ago. Market change, and it's a spiral.
So with all of that, I want to turn to you, Steve, for just a second. When we're talking about kind of things like, there are potential restructuring, things like that, when insolvency can't be avoided, can you just kind of talk through some of the best practices that you would advise clients on when they're starting to look at an assignment for the benefit of creditors or a receivership? What is the world of stuff that you look at when you start talking through those for people that might be getting ready to do that?
Well, once I rule out the out-of-court resolution of the debts and we start looking at these in-court options, I always tell clients that the best prepared you can go into one of these opportunities, the more likely that you'll come out of it successfully and more quickly and less expensively. For example, if you start into the benefit of creditors and you already have a buyer for the company, and that it's just a matter of getting through the legal system, you'll be a lot better off than if you start the assignment for the benefit of creditors without a buyer, and you have to go through a marketing process, and it just becomes a lot more burdensome and takes longer. you can sell a company in an assignment for the benefit of creditors in 60 days or less, if you have that buyer on day one. So that's important. And with respect to marketing, assignments for the benefit of creditors, which are court supervised in most of the states, will ultimately, on the day of the court approving a sale, will inquire as to what the marketing efforts were, so that the court knows that there were marketing efforts such that the maximization of return is as high as possible for the creditors. So to the extent you can market the company, again, before the ABC, that will cure one of the hurdles that's likely to come up during the court proceeding. So those are ways: the marketing, the finding a buyer, getting into an asset purchase agreement. The more you can do the benefit of creditors, the less you'll have to accomplish during it, and it'll just go a lot smoother.
And I'm going to come back to you in just a second, because I want to ask you a question about some debt issues to resolve, but I want to go to Peter Murphy to see if he had anything he wanted to add to that.
Yeah, thanks, Ruth. And, to Steve's point, there is this, because it's cannabis, right? It's going to have all kinds of extra, wrinkles, regulatory wrinkles to it, which is all of the states where cannabis is legal have different rules, some of them similar, but on the transfer of a license or the transfer of ownership of an entity that holds a license. So depending on whether something ends up in a receivership situation, or there's even a way to strike a deal that will involve the change in who holds the license, you're going to have to run sort of in parallel a regulatory process to make sure that there isn't any sort of transfer that would either void the license or cause some other issue on the regulatory side. And the reason that exists is these competitive processes to get these licenses requires a lot of vetting of whoever is holding it. And so the idea that you could just transfer this to some new owner or somebody who's responsible now for dealing with the inventory and making sure people get paid, it's never that simple. It usually will require the active engagement of the state regulator for cannabis in that state.
And so, Steve, I want to come back to you on some of the issues that we're dealing with when you're getting ready to go through an ABC or something like that. And I think everybody's point is, these are businesses, right, that have employees, that have operations ongoing. So are there certain types of debts that you look towards? I know we had talked a little bit about some corporate debts and payroll responsibility and things like that. If you could just comment briefly, that would be great for folks to hear.
Well, the interest of a principal of a troubled business will ultimately be, what will they be personally responsible for? It's one thing for the corporate debts to not get paid, but the individual wants to know, after all the dust clears, what's going to be sticking with him the rest of his life in a debt-wise. And those debts are usually payroll taxes, sales taxes, any personally guaranteed debt will stick with them, and credit card debt. A lot of businesses use their credit cards to fund the operation, and in most cases, credit cards are personal responsibility. So the individual principal is going to want to make sure that as much as possible of all of those personal type debts will be cleared up. Because once they go into this insolvency proceeding, those will get paid a portion of what they're owed, but there will still be a big deficiency in most cases. So I would say to the individual, take care of your sales taxes, take care of your payroll taxes, and we'll take care of the corporate debt.
So we've talked a little bit about restructuring, about assignment for the benefit of creditors. I want to turn to receiverships, because those really are a gem in the state law schemes when we start dealing with restructuring and insolvent businesses. So we've seen, obviously, because of this bankruptcy issue, receiverships on the rise in the cannabis industry. And Jacques, I'm so glad we have you, because you've actually been involved in a receivership for a cannabis entity. And I was hoping maybe you could share some lessons learned from that, and kind of all of the morass that goes with it for us today.
Yeah, well, yes. So our firm has done turnarounds and distressed assets outside of cannabis for the past 15 years. So it's a little bit kind of interesting how our cannabis practice and our turnaround practice all come together. And for the past 6-7 years, we've been involved with some clients in some challenging situations, but they were solved out of court. Right. So remember 5-6 years ago, one company decided to spend a lot more than the cash they had to buy products. And of course, everybody was knocking at the door, and we had to put in place traditional turnaround methods to negotiate with people. And that stayed out of court. And we worked with the investors, and everything got resolved. Took a little bit of time and a lot of stress. But now we're getting to some points where there's no other options, right? Receivership ends up being a solution. So not every state have a receivership a proceeding available to them. Not every cannabis regulation have it, but I know there's been a few in California. There's, I think, a couple in right now in Michigan. And we were involved in the first one in Massachusetts that we are wrapping up now. Started now a year and a half ago or so. And, of course, right, the receiver and the receivership proceeding happens after the fact, right? The parties are in the court, nobody's happy with each other, you got to find a solution. And the receiver ends up being that person, person or that team that helps the company and the investor and the debtors and the creditor and the debtors and everybody to try to find a path where the cash flow is going to be maintained, the value of the company is going to be maintained, while we're finding a path to resolve the issues. Like Steve was saying, usually nobody gets everything that they want, right? But you're trying to find a way for everybody to get a piece of something. You're trying to preserve the brand, you're trying to preserve the jobs, trying to preserve the value of the business, and try to find a way for get cash in. So finding a solution has different form. Most of the time you think about selling the company, which is what we did. We, like I was mentioning earlier, we are wrapping up the Airmont Inc. case in Massachusetts, which was the first one in Massachusetts, and actually I think on the East Coast in general. And we looked at different options, but very quickly it was obvious that due to the debt and due to the asset, selling the business was one thing. So like was said earlier, we had a sale or a search, I should say, a search for a potential buyer. Took us 2 or 3 months. We did not do an auction because I didn't feel like it would be a good way for Airmont to get the best value. And we identified 25, maybe more potential interested parties, ended up having a few parties interested, and we presented a potential buyer to the court that was approved. But overall, what was interesting in this case is that some of it could have been resolved early on. And unfortunately, like I said earlier, the communication is broken. And I think we have to realize that receivership is not cheap, right? I did a webinar a little bit like this a couple of months ago, and I got a couple of phone calls of people thinking, oh, I'm going to file for receivership myself. Well, you as a company are not going to file for receivership yourself. That's not the way it happens, right? The lender or whoever it is, right, is going to force the receivership. And two, it's not a silver bullet, right? It's not like you file and you're done. It's month of filings, it's month of negotiation. It's a lot of reports to the court and all the stakeholders. It's cash flow forecasts on a regular basis that you file. Of course, right, you look at the cash flow on a weekly basis, trying to, like I said earlier, salvage as much as of the assets as you can. And so it takes time, it's cost money. Favorite lawyers, of course, are involved. And the operational cost too of keeping a company that's in trouble, keeping it alive. One thing also that I think we want to mention, I think I just did a little bit, is the timeline. Airmont started in November 2021, and we are now in almost in the summer of 2023. And I think that case will be wrapped up, just sometime this summer. So it took probably a year and a half to find a path, to find a solution, get it approved by the court, and then also get it approved by the regulatory commission, right? So the Cannabis Control Commission in Massachusetts, had to approve the new operators and then give them a license. And just like any states, getting a license doesn't happen overnight, right? You get a lot of filing, you get a lot of paperwork, and then you have to be at the right time in the right agenda, and then so on. Something too that I wanted to mention about receivership, I think it's a good way for companies, cannabis operators to resolve, and lenders or creditors, right, to resolve the issues. But you got to keep in mind that there can be a damage to the brand. So if the buyer is a synergetic buyer, they might not care, right, because they're buying really the operational asset, and the brand is not considered. But sometimes you want to keep in mind the customers, right? And I think part of the receivership path is also to keep the customers happy, right? You want to keep them there to salvage or to keep the value of the company. And so overall, I think it's a good solution, considering the cost and the time it takes to get to the resolution.
Great. And I just wanted, is anybody else wanted to comment on that before I kind of moved on to the next topic we had?
I have one more comment. I think too, a part of the research, and I saw a question coming from our audience here around real estate and landlords. Yes. I think we got to landlords and in general, and the real estate professionals have to consider how they can keep a tenant, and they have to change the deals. So in the case of Airmont, we had a landlord that ended up changing during the proceedings, but they always try to work with us, and they knew the company was in trouble, but they always found a way to make it work. And then when we found a buyer and we put them in touch with the new buyer, they also worked with them. And I think that was key for the success of the receivership, because the one of the major stakeholder, the landlord, right, wasn't owed that much money, but it's still their building, right, was really on board of helping. And I think in general, the real estate professionals have to realize that deals that were made 3-4 years ago, it's probably going to be more and more difficult to have them now, and it's going to become just more of a traditional manufacturing or retail lease, and everybody's got to be creative.
Yeah, and I just want to kind of give some perspective to the folks that are out there. One of the question that came in was, how do we see local and national real estate providers kind of adapting to best support the expansion and growth of the cannabis industry, and what type of relationships those are? And I just, the reason that becomes an issue is when you have a plant touching cannabis business in a piece of real estate, that locks up that real estate with respect to some financing options and things like that. So I think landlords have to kind of understand what they're getting into when they start jumping into those relationships. And then, once you're there, how can you keep that space available for whoever's going to come into it next? So I want to talk a little bit about, the opportunities that arise with distressed assets. So, we've talked about kind of oversaturation of the industry. We've got a lot. We're starting to see things, fall out. Who's going to rise to the top? And since we've been talking about insolvency, there are some good things that come out of that as well. Or, it provides an opportunity for the larger players or folks that have been successful in the market to have opportunities to buy distressed assets, particularly in the cannabis space. So when we're talking about larger entities or more profitable entities coming in and looking at distressed assets, what are some suggestions that you all have for due diligence when we're talking about quote unquote fire sales or valuing those distressed assets? If we're looking at larger MSOs coming in and trying to pick up pieces of some of these companies, what should they be looking at? I'm going to go, Peter Murphy, I'm going to go to you first, and then I'm just going to go around the room and get some thoughts.
Sure. Yeah, apart from the obvious sort of financial due diligence that I'm sure Peter, Sue, and Jacques covered, but again, I come back to sort of the regulatory status, right? The license is often one of the most valuable things that company has. So you want to really get a sense of what the regulatory environment is like where you're buying it. Obviously, license value depends on the jurisdiction you're in, but also the status of that license. How has it been maintained? Is it being maintained? When is it up for renewal? Is it going to be renewed? There's a lot of history that kind of goes with that, and it all reflects on the value of what you're getting. And depending on the class of license, whether it's a retail license in Michigan looks very different from a cultivation license in Maryland. They're very fact specific inquiry from a regulatory perspective.
Jacques or Peter, Sue, if you had anything to kind of add to that when you're looking or helping folks kind of identify assets in distressed sales, if you had any tips.
Yeah, I'll let you go. I talked a lot already.
Go ahead, Peter. What do you got?
Well, so Peter Murphy is right. Regulatory. That's got to be key number one, number two, and number three. And actually, for a lender, a bank perhaps, this is a really touchy subject. Has the fees been paid? Have the taxes been paid? There was not to keep picking on Michigan, but there was a recent story where there was this is a legal licensed business that was taking unlicensed biomass to make distillates, and they were caught by their regulator doing that, and thus their license was suspended. As a cannabis business starts to get into trouble, starts to flounder, is there a possibility that there's an incentive to do that? Might they be more likely to start monkeying around with, playing fast and loose with the rules? Honestly, perhaps. And so as a banking institution, are we in a position where we might preemptively decide that this might be a situation that we want to get out of? So, if you're shopping and you're looking at one of these situations, what if you pick up a license and now you're actually forced to put more money in before you can even start making money on this company? You actually have to put more money into the company to get the license up to date, to get the taxes up to date, things like that.
Yeah, in my case too, I agree with what was said. I think also the market outlook is something to consider when you look at a distressed asset. So a company might be in trouble for all the reasons we talked about today. And maybe that company is going to still be in trouble for the next 6 months or a year because of the market or because of the competition. But we all know, and we already said, the market is still growing, right? New products are coming on the market. The regulations are changing. So, I think there's an opportunity for somebody to invest in a distressed company that may need more capital for the next 2 years. But then in 2 years from now, might be in a position to be a real player in a underrated market. And if it's a synergetic investment, then it's even better. I am not pro-federal legalization, because I think the industry is not ready. But we all know, and I know I'm not going to make some friends here, but I think most people would
Oh, I
agree
mean,
we
Peter Sue couldn't unmute himself fast enough, but go ahead, Jacques, finish your thought.
Are we recording this?
Yeah, no, I've said it several times. So I think the industry is not ready, right? And if it always happened tomorrow, it would be very catastrophic, because we need to work in a lot of those regulations and pieces. But nevertheless, right, the interstate market, could be closer on some regions, right? I know some New England states are talking about allowing interstate markets, interstate commerce, and things like this. So all that to say that some distressed assets now could be a gem 2 years from now if somebody is finding it at the right price after due diligence and willing to wait a couple of years for the market to flourish more.
You guys are just going to let that sit there. Nobody's got anything to say about that. Come on, Peter. So I saw you unmute yourself for a comment. Yeah, I mean, I think it's interesting, right? Because I think kind of bringing us full circle, right? We talked about this at the beginning, that the federal legality makes this a state-by-state market.
Yeah.
It makes it a state-by-state regulatory market. So I think Jacques' point is very well made, that an entity in a state that is distressed because it's in a very oppressive regulatory market in that state, if it was then, an asset that was part of a company that was across multiple states without those restrictions, what does that look like? And I don't think we all know the answer to that yet. But it's kind of really brings this discussion all the way back around. I think we're almost at time. I don't want to hold everybody later than that, but I do want to open the floor to the panelists to any final thoughts that they want to share with our audience today.
I have a final thought.
I know you, Steve. You have no final thoughts. They just keep going, but go ahead. I'll pretend like this is your final one.
This will be my final thought for now.
Okay.
I just want to say to all of our viewers, and whether you're looking to whether you own a troubled cannabis business or you're looking to acquire one, this may be obvious, but use the right professionals who have the experience in doing these things, because they know where to look. They know, for example, if taxes weren't paid or regulatory issues exist. So that will be critical in the big picture.
Yes, and I'll just comment, in this industry, there's a lot of people that are in it and that say they know what they're doing, and some of them may know more than others. So make sure that you're using your due diligence when you're looking at folks to assist you and help you. And Jacques, I cut you off. Please go ahead.
No, I was about to say exactly what you said. So yeah, and it works for operators and investors and lenders. After now the industry is what it's years, decades old, but for the past 10, 12 years, a lot of people have been working on this industry. There's a lot of good experience out there, and absolutely find the right people to give you some good advice.
So on that note, I'm going to conclude for the day. I want to say first a very big thank you to our panelists, to both Peters, Jacques, and Steve for joining us and sharing your experience with the folks that are joining us today. I want to thank everybody who joined today to listen. Really appreciate you taking the time out of your day to have this discussion with us. Just a reminder to keep an eye out for a follow-up email. It's going to include some links to the program materials and the recording. And I think we answered most of the questions, but our contact information will be in that email as well. So please reach out to any of us with questions. And with that, I think we will close, and thank you all. Have a good rest of the day.
Thank you. It's been a pleasure.
Thank you. Take care.